Hi everyone, so let's continue on 2011, paper 1, the multiple choice 11 through to 15 here. Okay, so the introduction of a congestion charge significantly reduces the volume of traffic on inner city roads, leading to shorter journey times. What will be the net impact on the economic welfare of those motorists who continue to make their journeys by car and those who switch to travelling by bus? Okay, so we've got shorter journey times here, and that's important there. So we can see that point. What will be the net impact? Well, it's difficult to say. If we concentrate on this this part of the table, this column here, the effect on those who continue to travel by car. So it's more than possible that they may actually benefit from this because they enjoy those shorter journey times, and they actually make a choice in terms of actually deciding to travel by car. So it's possible they could gain. At the same time, it's also possible that they have to actually conduct their business by car travel or van travel, whatever it may be. So for instance, they might be distributors or deliver materials or packages and so on. So in that case, that would actually increase the marginal cost of their operations. So we don't know whether they're going to lose or actually gain from this circumstance. We don't have gain as an option, so therefore we can certainly just go for uncertain. So we're led to C or D. So what about the effect on those who switch to travelling by bus? Well, don't forget, we've got shorter journey times. So if they're enjoying shorter journey times by bus, that is possible they could gain. At the same time, some people won't like travelling on public transport and would prefer to actually travel privately, and they may not want the additional cost of having to travel on public transport. So we don't know again, so therefore the answer, the most plausible answer is D, uncertain, because we cannot be sure. Okay, let's move it on now to question 12. Okay, so you can see just on the simple calculations here. Let's just work through what we've done. So the diagram shows the estimated demand curve for crossing a proposed new road bridge. The estimated annual capital and operational costs of the bridge amount to 10 million, as I've highlighted. There's no expected external costs or benefits, and assuming the bridge company sets out to maximize its revenue, and that's important, what would be the estimated annual profit or loss to the bridge company and the net annual benefit to society? So we can see here that the revenue maximization point would be 8 million. At the same time, we've got those costs of 10 million. So this is private benefit here, this is private costs, and there's no sort of social element factored in here. Okay, so as we look at this table, we can certainly first work out and determine where the answer is likely to lie, and we can see the firm will be worse off to the tune of £2 million. Okay, so it's therefore going to be A or B. And what is the net social benefit? Well, actually, society is benefiting from the fact that this firm has provided that service, but they're not necessarily making that profit from it. So in effect, they're almost being subsidized by the private sector. So the net social benefit would be 2 million. So therefore, the answer would be B. Okay, number 13. A firm produces only one product. Under which condition, is it most likely to be able to pursue a policy of price discrimination? Well, if you just think about where price discrimination is probably most commonly used, it tends to be in peak and off-peak times of travel that you're most likely to encounter price discrimination. There are, of course, numerous other examples as well, but this happens a lot, and that happens because of different elasticities of demand at different times. Okay, so therefore, both price and marginal revenue are identical in all markets. Well, that certainly doesn't fit the bill there, because at peak times, the average revenue curve would be, or the demand curve would be, very inelastic. It is benefiting from economies of scale. Well, this is about productive efficiency. This isn't really to do with price discrimination. its product has a low elasticity of demand. Okay, fine, but it doesn't tell us that it has differing elasticities of demand according to different times or different types of customer. So we don't know that. There are separate and distinct markets for its product, so therefore the answer is certainly D. Okay. Right, so number 14. So under the EU's emission trading scheme, heavy industries are issued with a quota of carbon permits, and companies that want more must buy spare permits from cleaner companies. Which combination of changes would be most likely to increase the price of permits? Okay, so if we just think about the nature of this and the demand and supply elements here, we can see the number of carbon permits issued. So in essence, this is going to be a fixed quantity. Meanwhile, the demand curve may look something like so. So we've got a supply curve there. So if they actually lowered the carbon permits, we can see, well, that would fit the bill. That would certainly increase the price of permits. Okay, so therefore we're immediately led to lower, A or B. And then we've got to factor in the rate of global GDP growth. So when is demand likely to be higher? Well, of course, it's likely to be higher during a period of economic growth. So therefore, we can go from D1 to D2, and we can see that we get a far higher price then than where we once were. Okay. All right. So therefore, the answer would be A. Okay. Number 15, firms X and Y operate in unrelated markets. The output of firm X depends not only on the quantities of factors of production employed by firm X, but also depends directly on the production methods of firm Y. Okay, so they're in unrelated markets. Now, the output of firm X depends not only on the quantities of factors of production employed by firm X, but also depends directly on the production methods of firm Y. Okay, so what does this illustrate? Well, it's most likely to illustrate an externality. The reason is because there seems to be a third-party effect here. Let's just run through the alternatives and just make sure that we're happy with this and answer. B, we've got complementary goods. Well, we can see they're in unrelated markets, so no. C, cross-elasticity of demand. Well, it says unrelated markets, so it's not that. D, horizontal integration. Well, horizontal integration would be integrating with another firm at the same stage of the actual production process. So previous examples there, you could consider, say, for instance, Safeway being taken over by Morrison's a little while ago now, but that's just one that sprung to mind. Okay, so that doesn't quite fit the bill because, again, we're looking at unrelated markets, and it's not as if it's focusing on conglomerate or unrelated sectors there. So A is certainly the best answer there. Okay, so it's third-party effects as a result of the process that firm Y is actually involved in there. Okay, all right, thanks guys.